Tax incentives are special provisions by the government, usually embedded within the tax laws, but sometimes not, which essentially either reduce, defer, or exclude a tax that would otherwise be payable, with the objective of encouraging investment in a specific sector or sectors, or generally to encourage certain economic activity.
There are some non-tax incentives to businesses intending to set up or pursue activities in Uganda. These may not necessarily be found in statute or in a formal government policy document, but they are available either as part of government's overall economic plan or on an ad hoc basis.
At URA, specifically in the domestic tax department, there are several tax incentives. There are sectors that are considered strategic by the government of Uganda. And at URA, we just provide a vehicle through which these sectors are incentivized. You know, WHT exemption is given to what we call compliant taxpayers before the eyes of the commissioner. What is being compliant? We look at several things. We have a checklist, and I can run through.
Good afternoon, everyone. Welcome to the Tax Hub podcast, a platform where we get to discuss, deliberate, and share any relevant and topical tax discussions. We make it very practical in that we can speak to the taxpayer. And on this episode of the Tax Hub podcast, we get to discuss tax incentives in Uganda. Are you an investor? Are you a business person? And you need to know what tax incentives and what tax exemptions, if any, are provided for in our laws. This is the right platform. We're going to unpack, we're going to take a deep dive on particularly doing business in Uganda, the ease with which we can, but also have a broader discussion on all the incentives, all the different exemptions in our laws, but also make it very practical in that we shall take a further step to guide you on how you can implement this, how you can apply for the same, what are some of the considerations that URA takes into place. All that is being unpacked this afternoon. And joining me this afternoon to unpack and to deliberate on this fundamental topic is a very formidable panel comprised of esteemed, experienced, and leading tax practitioners. But also importantly, we have a representative of the regulator, Uganda Revenue Authority. So joining me this afternoon in no particular order, firstly is Bruno. Bruno, you're very welcome to the Tax Hub podcast.
Thank you, Edwin, and our dear viewers. It's a pleasure to be here.
Thank you very much, Bruno. Good to have you. Bruno, our viewers would like to know who's Bruno, where do you come from?
My name is Bruno Kalibala. I am a lawyer, and if you like, for completeness, an advocate of the courts of judicature. I primarily practice tax and general commercial law, and I currently work with Grant Thornton, Uganda, as the manager, tax and legal.
Thank you very much, Bruno. Pleasure having you on the Tax Hub podcast. Our other panelist joining us this afternoon is Sophia. Sophia, you're very welcome to the Tax Hub podcast.
Thank you, Edwin. Yeah, my name is Sophia Nampija Senyundo. I work with Katende Sempewa and Company Advocates in the Corporate Transactional Department. I've been doing this for the past 15 years. Currently, I co-head the tax department together with Sim Katende. Happy to be here. Thank you for having me.
Pleasure having you, Sophia, on the Tax Hub podcast. So we have a tax lawyer with an audit firm. We have a tax lawyer in a law firm. Very, very rich experience. And the other gentleman joining us this afternoon is someone from the Tower, our good friend Twaha. Twaha, you're very welcome to the Tax Hub podcast.
Dear viewers and the rest of the team, a very good afternoon. Of course, my name is Twaha Kayondo. I sometimes add Mulangira. I come from the Uganda Revenue Authority. I am a trained tax officer. I'm a supervisor in the business policy division in the domestic taxes. I'm happy to be here.
Thank you very much. What Twaha didn't tell you, his department is the one that is responsible for sometimes even issuing rulings and confirming all these exemptions that we shall be discussing. But pleasure having you, Twaha. We're very honored to have you. Ladies and gentlemen, to kick us off, every time we talk incentives, it's always very good to first get to know business, how you can do business in Uganda, and the different business vehicles that are possible and you can do in Uganda. So to kick us off, Sophia, I'd like you to speak to our viewers out there. What are some of the different business ventures anyone seeking to operate in Uganda can undertake? If you could just give us high insights. There's that person who is, I want to operate as a sole proprietor, those with partnerships. What are some of these common different business ventures that they should look out for?
Thank you, Edwin, for that question. There are a number of business vehicles that people intending to do business in Uganda can use or can rely on. We have primarily three. We have companies, we have partnerships, and sole proprietorships. There are a number of other legal vehicles, but for purposes of this discussion, I will focus on those three. Under companies, which, by the way, is the most popular and best known among the business community or for investors, and we shall shortly look at the reasons why. But essentially, you can, they can be structured in two ways. You can have a private limited company or a public limited company. Now, the private limited companies, again, the ones which are most commonly used, and what are they? A private limited company is a company that comprises, historically only comprised either 2 members up to 50. But in, I think around 2012, the Companies Act was amended, and now we have even a single member company. So someone can choose to do business under a company that they own as a single member. Now, what does a private company mean? A private company means that you restrict ownership of shares and transfer of those shares. And this is different from a public company because a public company doesn't have that restriction. And what that restriction means is that you can invite the public at any time to come and acquire shares in your entity. But with a private company, this is not something that you can do. So it's why is it such a darling, or why is it loved by the business community or investors seeking to do business in Uganda? It has about 4 qualities. The first one is that once you incorporate a company, you can the company acquires what we call a separate legal personality. It means that the company can own assets in its name. It can sue and be sued, and it can, transact, enter into contracts, and do everything that a person or an individual would have done. It's just that now it is separate from the assets of its owners. And tied directly to that is the concept of limited liability. Once you do business as a company, then your assets, your individual assets, are protected from the liabilities of a company. So creditors cannot come after your personal assets, your residential home or your, other assets, your car. The creditors only have access to what the company owns, the assets of the companies, except in very limited circumstances where the law will allow the creditors or, anybody else that wants to settle their obligations to lift the veil and go after the shareholders. So we've looked at the corporate separate legal personality. We've looked at limited liability. It's also important to know that it's the most stated structure in terms of investors have certainty on the outcomes of using a company as a business vehicle. You know what the tax implications are. We have all these cases that, from a judicial point of view, have interpreted transactions conducted by companies, how they should be, who should sign, who binds the company. There's all that certainty. And also, most importantly, when it comes to attracting investors, any business, when it when it's time to grow or scale, you're going to look for investors or financials for your business. They love the structure of a company is known to them. All you have to do is either sell the shares, offer them shares in return for capital. So it's popular because it's known, it's tested, and there's a level of certainty for investors. Moving away from companies, so that's one. Moving away from companies, and maybe before I leave companies, there's also the issue of how do you register a company in Uganda? So we have two very popular forms, especially for investors coming into Uganda. We have, you can either register incorporate, what they normally call incorporating a subsidiary. That is, the foreign company comes into Uganda and sets up, and then it just owns the shares in the locally registered entity, or the foreign company will choose to come into Uganda and just register a branch of the foreign entity. And the two have different tax implications, as I think my colleagues will be looking at later in this session. Very quickly, on the other two, we have partnerships. The other two types of vehicles, you can use a partnership. Partnerships are really two or more people that come together and decide to do business together. The difference between a company and partnership, I think the most important one to raise on this podcast is partnerships. So there are two types of partnerships, what they call a general partnership and a limited liability partnership. The general partnership does not have limited liability for the partners. It means that the partners are the partnership. It means that even for tax purposes, URA is not going to go after the partnership. URA is going to go after the partners. Even in business, if a creditor or a counterparty to an agreement is seeking to enforce certain rights, they're going to enforce those rights against the partner and not the partnership. So the partnership doesn't have independent status. And I think to try and remedy this, we have seen in our laws, there's been an evolution and introduction of what we now call the limited liability partnership. It fairly recently, now we have limited liability partnerships. The Partnership Act actually, I think, was amended around 2022, and just earlier this year, we have the partnership regulations. And what the laws introduced were a limited partner. For the first time now, you can run a business as a partnership and have people coming in, maybe as investors, and for those people to have limited liability. So you can have a limited partner who will be protected. I can invest in the partnership, but my personal assets are protected. It is now the general partner who will be responsible, for running the partnership and for any liabilities that come up in the operation or conduct of that business. The last one is a sole proprietorship. A sole proprietorship is really an individual that decides to do business in their own right. Our laws permit them to register a name, can register a business name, and most of them usually will have so-and-so, such an entity, maybe Sophie and Daughters trading, or Sophia Nampija trading as Sophie and Daughters, that kind of thing. So there's no separation between the owner and the business. And you'll find that in practice, these are also not very common. They are usually for the smaller investors, for SMEs, people doing a bit of trading down there in Chikubo and in these other urban centers. But you will not find foreign investors coming in to do business as sole proprietorship for the reasons mentioned above. There is no separation and protection of their assets. So I think I'll just leave it at those three for now.
Thank you very much, Sophia. Sophia has been kind enough to give us the different business vehicles you can co-opt, and she was still kind enough to give us some of the considerations why any of those may be taken. So I want to bring in Bruno. Bruno, Sophia has given us different options of business vehicles that you can undertake in here. But I just want to now tweak it a bit tax-wise. Are there any tax considerations that we should take into place at the point when I want to set up? So is there anything or two that I may consider tax-wise?
Thank you, Edwin. Yes, indeed, when you are setting up a business, there are several tax considerations that have to be considered or taken into account. And these stretch across the the cycle of a business. The first phase being the formation stage. So depending on what type of business vehicle you're interested in, you will have to consider whether there are any formation taxes. These are taxes or duties that are applicable at the time of forming the business vehicle that you want to form. The second phase is the operation phase. Now you have gone past formation. You are now operating the business. How is the treatment for that particular business vehicle? And then to a limited extent, at the point of exit, when you're exiting the operations or the business activities, what are the considerations? So the considerations differ depending on the particular business vehicle that you are looking at. My colleague has discussed the three main ones: sole proprietorship, we have partnerships, and then companies. And I think I will address the considerations in that particular order, starting with sole proprietorships. One, in terms of the formative stages, there are no formation taxes, or what you would call capital duties, if I'm to borrow terminologies from other jurisdictions. So if you want to pursue business as an individual in your individual name, you can actually establish a business without incurring any tax bill, regardless of the size of the capital that you are deploying. To start with, of course, there is no mandatory requirement to register sole proprietorship, save for where you are perhaps carrying on a professional business, which as part of the regulatory requirements, you may be required to register. But generally, there are no registration requirements. So that means there isn't even a point at which government would be able to collect the capital duties. Now, when it gets to the operation phase of the business, and here we are assuming that you have been prudent in your affairs and you have returned a profit from your activities, the sole proprietorship profits or income are taxed in the hands of the sole proprietor. So that means your effective income tax rate or tax on your profits will essentially be determined by the progressive rates that apply to individuals under the now, I think, 4th schedule of the Income Tax Act. So there is only one layer of tax, and I will perhaps need to get into the company structure now at this point to further drive the point home. So when you look at a company, and as you're considering whether you should pursue business through the company, and we are assuming a company has been incorporated here, so it will have to be subject to a corporate tax rate of 30% for its qualifying profits. But then remember, after the company has paid taxes on its profits, the balance of the profits doesn't automatically become income of the shareholders. So for that income to become income of the shareholders, the company has to take a further step, which is to declare dividends. And when the company declares dividends, there is another point of taxation, because Ugandan law, particularly the Income Tax Act, taxes dividends at the rate of 15%. The company that is declaring dividends is required to withhold 15% of the amount paid. That's if the company is a private company, and if the company is listed on the stock exchange, the rate is 10%. So realize that a sole proprietorship, as compared to a company, there is only one layer of tax. On the other hand, if you pursue business through a company, it means first, your company will have to be taxed on the profits at 30%. And then when the company is declaring dividends to you as a shareholder, you'll also have to incur a tax bill of either 15% or 10%, depending on whether the company is listed on the stock exchange or not. And that also now takes me to partnerships. For partnerships, the law does not treat them as separate entities. that are distinct from the partners. And also the tax treatment and what you need to consider as you decide whether to pursue business through a partnership is that the income of the partnership is taxed in the hands of the partners. But what the tax law does is that it allows the partnership to act as a tax accounting entity. In other words, the partnership will file returns, report to the revenue authority, its revenues, its expenses, and then also show through its return how the profits have been shared amongst the partners. Normally, that sharing takes the ratio indicated in the partnership deed. If it's a formal partnership and there is a formal partnership ratio that determines the sharing of profits. Now, once the partnership has filed its return and it has indicated how the profits are shared, now the profits are distributed amongst the partners, and that means that the partners now will have to individually account for taxes on their respective shares. So effectively, that means in terms of the operation phase, the partnership and the sole proprietorship take more or less the same approach. So that would be a tax neutral aspect to look at. And then for companies, you have to consider the double tax layered structure in terms of the corporate profits and also at the point of distributing dividends. Also in the formative stage for partnerships, there are no capital or formation taxes. Again, you can form your partnership without incurring any tax bill. However, for companies, there is a duty called stamp duty. There is a 0.5% duty charged on the value of the share capital of the company. So that means as you are planning to set up a company for purposes of doing business, and normally companies that do business are set up as companies limited by shares. So that means you will definitely have a share capital, which will be taxed at a rate of 0.5%. But also what increases the formation duties or levies are the registration requirements. Because at the time of registering this company, because for companies it is a must, you must register. The registration fees are now 1.5% of the share capital of the company. So that means effectively at the formation stage alone, the company will have to incur formative costs that amount to 2% of its share capital, 0.5% being stamp duty and then 1.5% being registration fees. So again, those are considerations that you need to take into account. The other is the compliance burden. Obviously, for the company, the compliance burden rests squarely on the company itself because the law regards it as a separate entity. So if you're a shareholder, if you intend to be a shareholder and you want to invest in a company, that is something you have to take into account. Now, for individuals and partnerships, the partners are responsible for the compliance obligations. So that means if you're running a business, if you're planning to run a business as a sole proprietor, you also have to take into account the compliance costs, the compliance burden, and make sure that the company is compliant. I think the other aspect is access to incentives, because when you look at the tax laws and how the incentives are structured and how the practical requirements, because many times, whereas you have the requirements as set out in the law, the tax administrator, Uganda Revenue Authority, will also come in with its own practical requirements that you have to meet. And when you look at some of the incentives, for instance, I will point out the income tax exemption for strategic investments under, I think, the Income Tax Act, Section 21. When you look at the legal requirements have very huge or very large capital requirements, which sometimes can only be achieved by or through an elaborate capital and corporate structure. Probably you will need borrowing. For instance, for foreign investors, sometimes it is tied to $10 million US, 300,000 US dollars, the amounts are huge. And sometimes as an individual, you may not really be in position to raise the kind of financing. And so you might want to look at external financing. And most of the external financiers, most of the lenders that we have prefer the corporate structure. So that means you will be most likely find yourself in a situation where you have to consider a company if you are to benefit from those incentives to allow you achieve a corporate and capital structure that sort of fits within the legal and perhaps the administrator's practical requirements for qualifying for these incentives. So largely, I think that's the overview on some of the considerations to be taken into account. Also, the other aspect is on capital gains. Because Uganda adopts a narrow approach to taxing capital gains. Capital gains are only taxed if they arise from the disposal of a business asset. And so the law has adopted a limited definition of a business asset. But within that definition, you have basically all non-depreciable assets of a partnership and a company being within the definition of a business asset. So that means if I am an individual and I want to invest in a passive investment, let's say I want to purchase a certain plot of land that is on the market, no intention to do any business, just keeping it there. I know land values in Kampala appreciate. After 5 years, I dispose it off. If I do that as an individual, because I'm not using the land to do business, and the owner is neither a partnership nor a company, so it is not a business asset. So that means after 5 or 10 years, when I eventually dispose of the asset, whatever profits I make will not be subject to tax. On the other hand, if out of excitement, I purchase the land using my briefcase company that I incorporated yesterday, and I dispose of the land after 5 years or 10 years, the tax administrator will come for me to say, to ask me to account for tax, because the definition of a business asset includes any asset owned by a company or a partnership. And we have had these scenarios actually play out. I think recently we had a decision of the Tax Appeals Tribunal in Chandaria Foundation versus Uganda Revenue Authority. The foundation purchased shares at 49 million in around 2001 in a public company and sold those shares in 2021 at about 2.4 billion. And Uganda Revenue Authority tried to argue that the shares were a business asset. But because they were not owned by a company, they were not owned by a partnership, they were owned by a trust, and the shares were not used for any business. The trust was simply holding them as a passive investment. URA's assessment of about 900 million was set aside by the Tax Appeals Tribunal. So you can imagine the tax cost that the trust would have incurred had it perhaps acquired the shares through a company to say, let this be the investment vehicle for me to pursue this investment in these shares. So largely, Edwin and the dear viewers, I think that's the much I can say about tax considerations.
Thank you very much, Bruno. That was very informative. At least we now know a few of the tax considerations we should take into account when choosing whatever business vehicle you may decide. All right, I want to bring it back to my colleague, Sophia. So, Sophia, we're talking tax incentives, tax exemptions, but there's that viewer out there who's hearing this for the very first time. So, Sophia, what are tax incentives? What are tax exemptions for the benefit of our viewers out there?
Thank you, Edwin. Tax incentives are special provisions by the government, usually embedded within the tax laws, but sometimes not, which essentially either reduce, defer, or exclude a tax that would otherwise be payable, with the objective of encouraging investment in a specific sector or sectors, or generally to encourage certain economic activity. So tax incentives are a tool that is used globally by governments to attract investments in their jurisdictions. And this is part of the broader concept of what is called tax competition. Countries try to dangle their tax incentives to lure investors. For instance, in the context of Uganda, if an investor is looking at setting up a certain plant or manufacturing facility in East Africa, why should they choose Uganda over Kenya or Tanzania or Rwanda? And to be fair, the considerations are many. Investors would look at things like the strength of the legal and institutional framework. They will look at political stability, product market for the product, but the effective tax rate will also be a major consideration for investors seeking to do business. So the first is that it's used as a tool to attract investment. They also use tax incentives to encourage investment in certain sectors, to correct certain market failures, and also to invest in certain geographical locations. And we will see in this session the different incentives that government has put in place and the purpose for those. I'll just give an example. We all, we are all part of the green transition. The whole world is gravitating towards the green transition, and Uganda has also not been left behind. You will see that for the last couple of years, the government has tried to incentivize investors in that sector, whether it is electric vehicles, manufacture of electric vehicles, whether it is importation of electric batteries and charging facilities, whether it's in the power sector. The government is really trying to incentivize and encourage people to move towards cleaner energy sources by using the tax code. In terms of types, there are many, many types, but I'll just mention a few. I think the one that the buzzword is tax holidays. And a tax holiday is really a temporary reduction or elimination of a tax. It's usually for a set period of time. Previously, in our history here in Uganda, these were discretionary. We would wake up to a headline in one of the dailies, local dailies, that such and such an investor has been given a 10-year holiday. And the rest of the investors in that sector would feel like they were left, they were left out. So in order to try and level the playing field in 2018, after a lot of pushback from the investor community, the public, and finally this was debated in Parliament, the government enacted into law the 10-year tax holiday. It's non-discretionary. It targets specific sectors, and now it was in the statute. Now everybody, as long as you met a certain criteria, which is very transparent, you can qualify for a 10-year tax holiday. We'll go into the details of what those requirements are. Then most recently, in the last amendment to the Income Tax Act, there's also now been, for the first time, a 3-year tax holiday for SMEs. So tax holidays are no longer a thing for the rich or the haves. Now, even investors who previously did not qualify to get these investments now can qualify to get a 3-year tax investment, again, a tax holiday, again, if they meet certain criteria. So it's all transparent. The second type of incentive I'll talk about is the exemptions. There are certain types of income which I think if you look through the different laws, whether it's income tax, VAT, which are exempt from tax. I think one of the ones that for the business community, one of the ones that is fairly recent is the one on venture capital funds and private equity funds. And the reason is clear. It's really to make access to capital cheaper, especially for SMEs. So government has tried to incentivize many of these to come in because we know they are the ones that are lending to businesses or investing in startups and, all these businesses that will have such a huge impact on the economy. Apart from tax holidays and exemptions, we also have, so those are the ones I think which are outright incentives. But we also have others which are disguised, that on the look of it, you may not call them an outright incentive, but because they reduce the effective tax rate for an investor, they ought to be considered as incentives. So we have within the tax code what we call deductible expenses. So deductible expenses are really after I have made all this income. Do I does the URA come and slap the tax rate on that income, or am I allowed certain expenses that will ultimately reduce how much I have to pay? And we have a very broad framework and the Income Tax Act, which allows you to reduce all your startup costs, training expenditure, initial building allowances. You have scientific research or research and all sorts of expenses. For depreciable assets, I think there's also a depreciation allowance, which all effectively reduce how much you'll eventually have to pay in taxes. So that's something that investors need to look out for and to structure for. Then you have things like, again, disguised, but very important for an investor to look out for. You have things like deferment of liability, tax liability. For instance, we have in the VAT. We have what they call the deferment of VAT liability. This is usually for importers of plant and machinery. The law recognizes at that point you're still doing construction, especially for the large investors and different people in the business community. The law recognizes at that time you're just investing, you've not yet started making any money. So they defer the tax up to the point when you actually start to make the money. Then I think we also have rollover relief, where for capital gains tax, where if it's an internal reorganization between two entities which are ultimately controlled by the same owner, beneficial owner, the law recognizes that, okay, this asset is moving, but it's still remaining under the same ownership. So let us defer the tax until such a time when this person actually transfers to someone outside their control. A few others are things like credits. Again, for VAT purposes, we have what is called the input tax credit. Sorry, all the tax that you incurred in generating that income. Then we also have special incentives for special projects. These are usually for the very large projects. We have, for instance, under the ECOP Act, a whole framework of incentives that was designed just for purposes of helping or supporting the operationalization of the ECOP project. And ECOP is really means the East African Crude Oil Pipeline. It's tagged from previous valuations. I think it's tagged to be about a $3.5 to $4 billion project. So a project of that size, which is tagged to make a huge impact on the economy, create many jobs, employ many people, use so many locally sourced raw materials. The government obviously has to support those projects. So you'll find that under the ECO project has a 10-year corporate income tax exemption. They don't have to pay VAT. The contractors will charge it, but they don't have to pay for it. They are withholding tax exempt when making payments to them. The customers do not have to withhold any tax. So all these are different types of incentives. And maybe the last one I'll talk about is the deemed VAT. And again, this one is benefiting licensees in the oil and gas as well as mining sector and other, large projects. And essentially, you don't have to pay the VAT. The contractors or the suppliers will charge the VAT, but the government deems it paid. And why is that so important for a licensee or someone operating in that sector? It's so important because it frees up a huge amount of capital, which you can now invest in the business, employ more people, and focus on the operations instead of being burdened by the requirement to account and pay VAT. So, in a nutshell, I think those are the ones that I can raise.
Thank you very much, Sophia. Sophia has done justice to that. She has given us a different types of incentives, but going ahead to also give us examples of each of those. So just before I bring in Twaha to give us a different specifics, let me first bring it to Bruno. Bruno, outside tax incentives, are there any other non-tax incentives that any person seeking to invest or do business in Uganda can also pay regard to? And if any, how can these be obtained?
There are some non-tax incentives to businesses intending to set up or pursue activities in Uganda. These may not necessarily be found in statute or in a formal government policy document, but they are available either as part of government's overall economic plan or on an ad hoc basis. Usually those that are available on an ad hoc basis require some level of political lobbying and also some persuasion. But because I'm a lawyer, many times I tend to focus on what the law has provided for. And so essentially we have the Uganda Investment Authority, established under the Uganda Investment Authority Act. Essentially, it is the government body responsible for coordinating investment activities within the country. And pursuant to that mandate, it has been able to set up a framework within which some of these non-tax incentives can be pursued. I think some of the common ones include access to land in our industrial parks. The Uganda Investment Authority, of course, depending on availability, may allow you to access land in a developed industrial park, those that are developed and managed by the Uganda Investment Authority. Obviously, having space or access to land in a developed industrial park means you won't have to struggle with utilities. These are normally developed with an efficient road network, access to utilities like water, electricity. So ideally, they create an environment that is business ready. In other words, all you need is to come in with your equipment and set up whatever activities you want to set up. But also in instances where you are not able to access land in a developed industrial park, again, the Uganda Investment Authority can act as a pathway to private landowners that can actually either sell you land or lease you land or grant you some other form of access to land, it being a very, very major factor of production. Many of the activities will not be able to take place without access to land. So even in instances, for instance, now, I think at the moment, the Namave industrial park is full. So if you consult the Uganda Investment Authority for space there, you're most likely going to be told that there is no space. But even without such availability, the authorities is sort of able, of course, through discussions, persuasion, and some lobbying, they're able to connect you to private landowners that could be able to enable you access land. Maybe the other thing that I should have pointed out is these incentives are mainly available to investors that are registered with the Uganda Investment Authority. So as you intend to set up business in Uganda, depending on the level of your capital requirements or available capital, you may consider registering with the Uganda Investment Authority. They have categories for foreign investors and also for domestic or local investors, and the investors are categorized on that basis. Moving on to the other incentive that could be available as a non-tax incentive, you look at government co-financing of projects. Sometimes investors come up with all these beautiful ideas, but then sometimes their capabilities are restricted. It could be that there is no available, affordable financing on the market. And so, or they end up being unable to manage their liabilities as and when they fall due. So in those circumstances, there have been instances on an ad hoc basis where government has actually been able to come in to assist investors. I think some of the most recent cases include Rocco, one of the leading construction companies. Some time back, it was struggling with serious financial challenges, and government came in. I think also most recently in the newspapers, there are discussions on whether government should actually come in to assist the Ndere Center to try and help it overcome its current financial challenges. And the challenge with this is that despite the constant and repeated concerns that have been raised, when it comes to government co-financing or government bailouts, there doesn't seem to be any publicly known, publicly debated policy that guides government's actions in that regard. So sometimes those that feel should be assisted are not assisted, and sometimes those that people feel shouldn't be assisted end up being assisted. And so I think from a policy perspective, there needs to be an enhanced level of transparency in how those particular incentives are managed. Then in terms of the overall economic policy, when you look at the essential aspects of production, especially utilities, I think the most notorious one is electricity. The government has consistently maintained lower tariffs for industrial use, which is a key aspect for especially the manufacturing and agro-processing industries or investors. So that could also be viewed as a non-tax incentive that perhaps investors need to consider. I think the others from a macroeconomic perspective also that you could think of or mention when you look at a liberalized foreign exchange market. This happens to be something which people in Uganda tend to take for granted. But many times when I am advising foreign investors setting up in Uganda, one of the questions they ask is the foreign exchange market liberalized or is it controlled by government? So the fact that the foreign exchange market is actually largely liberalized, save for one or two instances of regulation by Bank of Uganda, you can purchase dollars, you can purchase the British pound, you can purchase foreign currency on the street in Kampala, provided the traders are regulated by Bank of Uganda. There are no quotas, there are no limits that an individual shouldn't purchase beyond or shouldn't acquire beyond this amount of foreign exchange. So that again, though largely a macroeconomic policy, can also be viewed as a non-tax incentive because access to foreign exchange, that means it eases trade, and definitely that means that businesses will be facilitated. The other aspect, again, to do with the Uganda Investment Authority, for registered and licensed investors, they're able to benefit from the authorities' training program, especially for the local investors. So if you submit yourself and you register with the Uganda Investment Authority on one or two occasions, you might be able to benefit from their investor training programs, which enables the enhancement of local capabilities and capacities in terms of our local investors. So largely, and from a very broader perspective, I think those are some of the non-tax incentives that our viewers need to be aware of.
Thank you very much, Bruno. Those that are equally pertinent considerations that we should take into regard. So Bruno and Sophia just wore the patriotic hats, and I indeed confirm that Uganda is a very attractive country for investment. We've listened to those important considerations, but also the government's strides in trying to attract foreign direct investment can't be taken for granted. So let me bring in Twaha, my good friend Twaha. So Twaha, now that we know what tax incentives and exemptions are, let's just dive deep down there. So what are some of those tax incentives and exemptions that we have in Uganda from a domestic tax perspective?
Dear viewers and panelists, once again, good afternoon.
Good afternoon.
At URA, specifically in the domestic tax department, there are several tax incentives. There are those ones that are considered strategic, that have been designed by policy to allow strategic investors to come and invest their money in here, and then we benefit from the trickle-down effects, not necessarily from the tax point of view. You look at what my colleagues have already dived in, especially Sophia. She has hinted about several of them. But to be specific, there are sectors that are considered strategic by the government of Uganda. And at URA, we just provide a vehicle through which these sectors are incentivized tax-wise. And if you look at those different sectors, you realize that sectors that are engaging in, say, in the processing of agriculture, in the manufacturing of, say, Sophia has already hinted, we are going green, manufacturing of electric vehicles, manufacturing of electrical batteries, and then the charging systems, those ones that are manufacturing chemicals used in agricultural production, those ones that are manufacturing machinery used in agriculture, those ones that are used, sectors where the investors are going to manufacture health-related sanitary pads, name them, and those ones that are investing in, say, in the production of instructional materials, all those sectors have been considered strategic. And therefore, at URA, we are incentivizing them through a policy by government to allow them have a 10-year income tax exemption. However, when we come and dive into a 10-year income tax exemption at URA, the viewers and the investors intending to come to Uganda who are already in Uganda should know that it's not a blanket exemption. It's tagged with conditions that must be fulfilled. Bruno and Sophia hinted on some. For example, if you want to benefit from the 10-year income tax exemption resulting from the above sectors, when you are investing in the above sectors, there are capital requirements. We will look at the magnitude of the investment you're bringing in Uganda. We look at the capital, how much, and the law cuts it clear that if you are a foreigner, you must be investing a minimum of 10 million US dollars. 10 million US dollars for a foreigner. And for a citizen, you must be investing, or you must be ready to invest to a minimum of 300,000 US dollars. That is for a citizen. And the law further breaks it that if you are a citizen and you're going to invest in a radius of 50 kilometers outside Kampala, which we refer to as a country, then for you, 150 US dollars, you'll benefit from this exemption. It doesn't stop there. You realize that, of course, to the viewers out there, they should understand when I say meaning of a citizen for tax purposes in Uganda means a national within the East African community. So a Kenyan is a citizen for investment purpose here in Uganda. Okay? So you realize that after having brought in or met the capital requirement, there are other conditions because government gives you with one hand and it expects to benefit indirectly from the investment. You must certify that you're going to employ Ugandans because it's a give and take. We are really giving you, we are incentivizing you, you're going to operate for 10 years and you're not going to pay any income tax. However, we are saying at URE and the policy at government, you must be able to prove that you are employing at least 70% Ugandans. And it doesn't stop there because you could go and get casual laborers and you employ them and they are really constituting 70%. We are saying no. We must also come and see your payroll. What is your wage bill? 70% of the wage bill should be seen going to Ugandans. Okay? Should be seen going to Ugandans. And then the other consideration we look at is that we want to really certify if we have raw materials in Uganda, subject to availability of these raw materials, you must be using at least 50% of raw materials that are being produced in Uganda because we really want to have a chain reaction from giving us the employment, but also tapping into our raw materials other than you importing the raw materials that are available in Uganda. Okay? And then you realize that the other condition is that you must show us how are you going to capitalize? What is the source of the investment? What is your source of income? Are you going to finance the investment through, are you going to borrow? Do you have the money yourself? Okay, we look at that. We also want to look at your investment plan. How much are you investing? Because the law categorically states that if you are investing 10 million US dollar at the beginning, you automatically qualify. But it also comes with another version for those ones that have already been existing. If you have been in existence, how would you benefit? Because it would really be absurd if we only say as long as you are investing at the start. So we are considering others. If you're coming in, at what point have you crossed the threshold that you will benefit from the exemption? It's very critical. You may have started with, say, 150 US dollars as a Ugandans, and you're operating within within the suburbs, not up country. And then after 1 year, as per your investment plan, we see you've hit the required, say, 300 USD. then you will be required to apply in writing to the commissioner that you have satisfied the requirements to be considered for the 10 years income tax that is specifically given to strategic investors, for example. And then we will request you for different procedural requirements that you have to submit at URA for verification, because really it's not a blanket exemption. If it was, then every Tom and John would be coming and say, hey, look here, grant me the exemption. Okay? So we will tell you as below. We will certify the 10 million USD for a foreigner, the 3,000 for a citizen, and for those country and their citizens, 150. We confirm you have met the requirement. We go and look at how much are you employing Ugandans. We will request you for your incorporation documents. We will request you for the certificate from Uganda Investment Authority, granting you to really come and invest, because they are the custodians of investment. Then we will look at your investment plan, as earlier on highlighted. You're saying you're going to invest so much, you have invested so much. In project planning, you can relate it to the Gantt chart, step by step. Then we will also look at how are you adhering to the provision of giving Ugandans employment. We request for contracts of your employees. We request for payrolls, but also documents that satisfy their citizenry. To confirm that the 70% required employment threshold for Ugandans is met. If you are going to finance the investment by borrowing, we would want to certify ourselves by looking at the financing agreements, the leases, the mortgages, and all of that. We will want to look at the structural plans, because at one point you're going to benefit from an incentive, say, of excise duty on construction of factory buildings, the materials subject to availability in Uganda. So we want to see the bill of quantities. So having fulfilled all that, then the commissioner can comfortably say, yes, this person, when we looked at the structure and the bill of quantities required, they are not exaggerated. Ugandans are employed. Our raw materials are going to get market. Government of Uganda is going to develop the suburbs outside Kampala, okay? Because the other one is tagged at extending development outside Kampala. That's why we are lowering them by putting a lower investment capital. Then we will process your tax, your income tax exemption for 10 years. And this income tax exemption is not cast on stone. Okay? It is not cast on stone. The Christians normally have the Torah that was given to Musa, who is Moses, which was cast on stone. This one is not. It is subject for timely reviews At URA, as the administrators, will often come and make spot checks to certify themselves that the conditions under which the exemption was granted are still being followed. That is the strategic 10-year income tax exemption. But there are several others, like my sister and Bruno already hinted. For example, we have another 10-year income tax exemption to investors who export 80% finished consumer products or capital goods. When I say finished capital goods, it means that finished consumer, these goods are ready for consumption. They have been processed in Uganda. You have done value addition. The rationale is to promote value addition, but also have some foreign currency earned. Okay? You know the economics there. So, in order for you to attain that kind of exemption, one, you must be exporting 80% of finished consumer products. You must be compliant in the face of the commissioner. You file accurate and reliable returns, and you make timely payments. Leaving that aside, I have seen times where when we say you're exporting, many business persons rush and come and apply for this exemption. They should certify themselves that when we talk about exportation, for purposes of the definition of exportation in the Income Tax Act, it means to cause or to move those specific items outside a partner state. That is very crucial. Outside a partner state. So I have had instances where Ugandan is exporting finished maize, milled maize flour to South Sudan in huge volumes, and they want to qualify for the exemption. They have exported, our sister country, Kenya here, often come and pick maize and all those processed maize products from Uganda. And then somebody comes and wants to qualify for exporting 80%. It should be taken on record that is simply, you'll be like you've just transferred from Uganda to Kenya, but you've not caused in the definition of an export in the income tax as defined in the Income Tax Act in relation to the East African partner states. So you must be exporting to either COMESA, to Egypt, to the United States. Then you're going to be in the meaning of exporting 80% finished consumer goods. And if you'll find people who come like they have, coffee or cocoa, fresh from Bundibujo, dried granules, packed in sacks, and then being exported. And then somebody comes and tells you, I'm exporting a finished consumer product. As long as you're exporting it as a raw material and it's going to go to the other side and it undergoes through further production and processing to have now the delicious cocoa drink, to have the delicious Ugandan coffee aroma, as it is termed in the UK and sold expensively, you can't qualify because you've only exported a semi-processed product. It's not a finished product. However, if you processed the coffee here, credit the Ugandans who have started and brought the idea that is in Rukunjiri. Have I seen it in Rukunjiri? Where they are establishing coffee processing and value addition, value chain addition to coffee. And so if we are now exporting that famous aromatic Ugandan coffee, as it is named in Italy and the UK, finished product, ready to drink, then you will qualify for the 80% income tax exemption in that regard. We have other exemptions, like she has talked about further still in the Income Tax Act, all deductions, like you said, that are allowable in before deriving chargeable income are classified as tax incentives on interest, depreciable assets, donations. There is a famous one where you employ 5% disabled and we grant you 2% income tax exemption, scientific research, startup costs, all those ones for investors who are in commercial rent and they are performing as companies. There is an incentive of 50% allowable on the expenses that are incurred in generating that specific income. And you realize that we have other exemptions that are on stamp duty, that are on excise duty, that are captured in the VAT Act. For purposes of stamp duty, we have a tax incentive where if you say you're going to invest in Uganda and you are acquiring, say, land, your debentures, further charges, and then on lease and transfer of land. Okay? If you are investing here and the investment capital falls within the already highlighted bracket of 10 million and all that, you will still come this side and qualify for that exemption or tax incentive. We have a famous one where we are incentivizing Ugandans and foreigners who are able to establish specialized hospitals. You establish a specialized hospital and you are investing to a specific tune, you will come and qualify for a 10 years income tax exemption. You would be there and you are, say, planning to import machinery that you're going to use within your investment, your factory, you're setting up and you're importing machinery from China worth, say, $1.2 million US. We grant you what I know my brother would want to hear, the famous withholding tax exemption. 6%. Because if you look at 6% on $2 million US, it's not small money. So we are saying capitalization. We grant you the exemption and you import that plant and machinery here. We further also grant you deferment because we are saying you're simply starting. Why are you now paying this VAT? Let us defer, okay? Perhaps for a period of 2 years. If you have commenced and then things are well, you will come and pay VAT. As long as the value of the import is at least $4,000 US. You realize that there are other exemptions which are tagged on, say, certain investments. If you are investing in treasury bills, okay, you will have some withholding, for example, say on the interest earned, because it may be considered as a final tax somewhere. So you will not incur. And then when we look at the VAT Act, what is exempted in the Income Tax Act for purposes of strategic investment is carried forward this side. We will exempt you on the feasibility study when you are planning to construct, say, a factory that is going to be producing electric vehicles. Do you remember that we've exempted you income tax the other side? We are bringing it and replicating it here. We will exempt you stamp duty and excise duty on raw materials, for example, for excise duty on raw materials that you're going to use in the construction, provided or subject to being available in Uganda. When you are, for example, a commercial farmer, you know very well that agricultural products are not vatable. But because we want to encourage you stay afloat, the costs incurred by a commercial farmer that have a VAT component, we allow them to register for VAT such that they will claim the input tax to keep them afloat and maintain the investment, and many others. I think time is not our best ally.
Yeah, thank you very much, Twaha. Definitely, we can't exhaust all of them, but yeah, Twaha is kind enough. He'll definitely be hosted again on another episode so that we can go through each of those specifically. But Twaha, just before I let you go and I bring in Bruno, withholding tax exemption is one of the most contentious, yeah?
Yes.
Every year people apply, then you find someone was exempted last year, this year they're not. Are there any focus areas that taxpayers should get to know from a URA perspective? Are there any things you look out for? Why is it that some people are allowed, others are not? Just briefly on WHT exemptions.
Sure, and briefly. WHT exemption is given to what we call compliant taxpayers before the eyes of the commissioner. What is being compliant? We look at several things. We have a checklist, and I can run through. First of all, we must look through that your tax profile is up to date. Email, whatever is up to date. We must certify ourselves that you've been on the tax register for a period above 3 years. While you're on the tax register for the period of 3 years, we are able to see your tax behavior or the different taxpayer behaviors. Definitely. Are you elusive? Do you have liabilities? Even when you have liabilities, you're not elusive, you are available, we have memorandums, you're honoring them. Do you have, say, for example, if you've had an existing income tax exemption, you are in a different class. Do you use EFRIS for VAT registered taxpayers? Have you been named or investigated by the Tax Investigations Department before for any tax crimes? Have you been contributing tax? And for the viewers to mark this, we have a threshold that we start if we are to process your application for income tax exemption for WHT further. Have you contributed at least 50 million Uganda shillings in domestic taxes in the last 12 months prior to your application? Are all your directors declared if they are under directorship employment, are they declared under payee? If not, are they filing individual income tax returns? And are these declarations sufficient? Are they declaring incomes from all sources? Because you will have a director who doesn't earn here, but from our third-party information has a wealth of rental property, doesn't file returns. Because you are an associate, then we will link you up and we cannot process that income tax exemption for WHT. So basically, we want a compliant taxpayer 350. Compliance doesn't mean you don't have a liability. You may have a liability, but how do you behave? How do you behave? Some people are getting withholding when they actually don't have any business. Maybe they are rice import. They are different persons who are engaged, say, in rice importation, and one person comes, charges them, and because he's withholding tax exempted, they all capture their imports through that same specific person. So there are many things we look at. And if you really, we find ourselves that you're qualifying, minimum for a small taxpayer is 50 million Uganda shillings, particularly in domestic taxes. You may have one import, which is one, and you're paying 150 million in a container. That one is not considered. We are looking at VAT, income tax, pay as you earn. Okay? I think that brings the question to justice.
Thank you very much, Twaha. That was very important. At least what Twaha is confirming to you that they undertake 360 compliance. Don't just file your returns and that's all. Ensure you are in total compliance. So Bruno, maybe just to drive the point home, how important are WT exemptions and what's the process of applying for these? There's a taxpayer who wants to know a thing or two.
I think to understand the importance of WHT exemptions, we need to first of all understand how WHT mechanisms work. So essentially, this is a tax collection mechanism. Whereas we call it withholding tax, there isn't a distinct type of tax called withholding tax. Mm-hmm. This is simply a method of collection. In Uganda, I think we normally use it for income tax and value-added tax. So how it actually works is that if I am the business and I supply goods or services to a certain client or customer, that customer or client may be required, depending one, on the type of services I have provided. Secondly, on whether they are designated as withholding tax agents. So they may be required to withhold a certain portion of my fees or my payment that they have to make to me. That portion is 6% for income tax. It is also 6% for VAT. Now, once they withhold the 6%, they are required to remit it to the Uganda Revenue Authority. And I think the system is designed in a way that the person whose payment has been withheld is supposed to receive a certificate to that effect through their URA portal account, evidencing that indeed money has been withheld from your payment and the same has been remitted to the Uganda Revenue Authority. Now, once that money gets into the hands of the Revenue Authority, it is treated as an advance payment of tax by me, the person whose payment has been withheld from. So that means if today I supply Edwin services worth 100 million, the withholding mechanism will require him to withhold 6%, which is 6 million, remit it to Uganda Revenue Authority. That remission is supposed to happen within 15 days after the month in which the payment was made. And so now that 6 million will be credited to my income tax or VAT ledger, depending on whether the withholding was for income tax or VAT. And then when I finally compute my tax liability, for instance, for income tax at the end of the year, or for VAT at the end of the month, once I compute my tax liability and say for the year 2025, my income tax liability is so much. For clarity's sake, let's say 20 million. It means all the amounts that was withheld from my payments during the course of the year are supposed to be offset, or are supposed to offset my final tax liability. So in this case, if my liability is 20 million, the Uganda Revenue Authority is supposed to take into account that there is a 6 million, which I paid in advance when Edwin withheld from my payment of 100 million. And therefore, instead of the 20 million that I've determined to be my final tax liability, I will instead pay 14. So that's essentially how the withholding tax mechanism works. Now, in terms of importance and how beneficial it could be to a business, cash flow is the blood that runs businesses. So the unfairness with the withholding tax mechanism is that it allows the revenue authority or government to collect tax even before, one, I establish if I will have a tax liability to pay at the end of the tax period, and secondly, before I even determine what the tax liability would be. So in that sense, the withholding tax is a bit unfair in a way that it compels taxpayers to pay taxes before they even determine, one, whether the taxes will be due at all, and secondly, how much will be due at the end. And through that unfairness, it robs the business of cash flow, which could have been used by the business to offset or extinguish or clear other monetary obligations that might be due and payable in present terms. And so when you apply to the Uganda Revenue Authority and you satisfy the requirements that Mr. Twaha has very eloquently discussed, that means you will essentially save your cash flow. When you provide services for 100 million, instead of receiving 94 million, you will actually receive 100 million. And that means at the end of the relevant period, whether it's a month for VAT and a year for income tax, you will be able to determine your tax liabilities and pay what is due from you, as opposed to you having so much of your money locked up with Uganda Revenue Authority, and then at the end of the relevant tax period, you again have to perhaps even engage the services of a professional to help you get the refunds in the event that your ultimate tax liability ends up being less than what was withheld from you. Then you are in what we call a credit position. So you would ordinarily be entitled to a refund. But now that refund is easier said than gotten. Many times URA will put up all sorts of excuses. We have to first audit you. We have to do this. You have to first do this. You have to do this before you actually get the refund. So when you get the exemption from withholding tax, you're first of all saved from losing cash flow. And so you have money to offset more urgent monetary obligations. But also you're able to only pay tax after you have established how much is due from you. And secondly, you are saved, thirdly, you are saved from the burden and the bureaucratic steps that are involved in trying to get a refund of excess tax paid from the Revenue Authority. In terms of how to get the WHT exemption, it is applied for on an annual basis. So normally at the start of the financial year, you will have to submit your application. It is advisable that you submit before the end of the previous financial year so that the Revenue Authority has time. Sometimes they say we won't consider them until the financial year has started and all those things. But you have to lodge the application. The application is done online through your taxpayer URA portal. And then you will have a set of questions that you will have to answer. Those questions are meant to establish your compliance overview, because URA wants to know whether at the end of the relevant period, whether income tax or VAT, this person that we are exempting from the withholding tax arrangement is in the habit of actually fulfilling their part of the bargain, which is accounting for taxes rightly, and secondly, paying them. I think what has been unique this year compared to the previous years is the requirement to have made a certain amount of contribution in terms of revenue. Because I think that requirement assumes that all businesses are profitable. Because I could actually be a large business employing a significant number of people, but in actual sense, I'm in a loss position, either because of unfavorable business conditions or simply arising out of a massive capital outlay in the previous years, which entitles me to significant capital deductions and carried forward losses. Therefore, meaning that for now, I may not be in a position to actually pay 50 million Uganda shillings in tax. But also for small businesses that are loss-making, it is very possible that they can't quite meet this tax contribution threshold. And essentially, if you're looking at businesses that are not in a position to meet the 50 million threshold, those are the businesses that actually need the cash flow more than anything else, because it means they are probably operating on a very thin line. And if you take away their cash flow, they may eventually be unable to sustain operations and probably close down the activities, which in the long run hurts not only the economy but also the revenue collections. So ideally, that's it. Many times URA will push back once they have reviewed your application, because this sort of delays their collection of tax if they grant you the exemption. So they will put up a fight to make sure you don't get it. But you need to have people on ground. You can always engage the Revenue Authority. For the times when I have had to engage them, they have been perhaps willing to listen in some instances. So essentially, I think that's it in terms of the benefit and how to get the WHT exemption.
All right. Thank you, Bruno. Yeah, Bruno just confirmed to us how integral and how important it is to get that exemption. It saves you quite a lot. I want to bring in my good friend, Sophia. So, Sophia, every time we speak tax incentives and exemptions, definitely the double tax agreements come into the picture. We always get these inquiries from different clients who are possibly out of the country that are seeking to invest in Uganda. Are there any considerations we should take regard to? So, Sophia, I just want you to come in and expand for us the DTA regime in Uganda. Does Uganda have any DTAs? If so, what should we take into consideration broadly?
So thank you, Edwin, for that question. Double taxation agreements are really agreements signed between countries to protect entities or businesses earning income in one country from being taxed again on the same income in the other country. So Uganda has in place about 9 DTAs, 9 double taxation agreements with the UK, we have Netherlands, we have India, We have South Africa, Mauritius, Zambia, and a few others. Now, in the context of incentives, what do the DTAs help? I think I'll be very brief also in the interest of time. What the DTAs really offer is, in some cases, an exemption, an outright exemption on some income, but in most cases, it's a preferential tax rate. So I think the most common incomes that have provided for under these DTAs, we have interest, we have dividends, we have rent, and so on and so forth. So basically, if you have an investor who is based in the US, that's their area, that is their country of operation, that's where they have economic substance. They come into Uganda and are doing business, set up a subsidiary in Uganda. At the time when they are repatriating that income, at the time when you're paying a dividend back to the UK shareholder or the Dutch shareholder, what the current rate in place under the Income Tax Act is 15%, but you'll find most of these DTAs are providing a preferential rate of 10%. And in some cases, it's even lower. And I think another point to note about the DTAs, it's really income tax based. You don't have a lot of VAT and some of the other taxes being, receiving preferential rates for those. So in terms of structuring, you find that most investors planning to do business in Uganda and have the intention of ultimately repatriating some of that income back, they are going to try and structure through one of the 9 countries that have DTAs with Uganda. For that reason, to have that additional incentive of a reduced tax rate when repatriating the income back to their countries. So in a nutshell, I think in the interest of time, I'll just say that about the DTAs.
Thank you very much, Sophia. At least if you are a foreign investor and you're coming from any of those countries, it's good to take note that Uganda has DTAs in place that will be of much benefit to you. I'll bring it back to my colleague Twaha from the Uganda Revenue Authority. So Twaha, from your broad experience, you engage with taxpayers applying for these exemptions. What are some of those common mistakes you keep seeing on the daily happening that you think you should speak to that taxpayer out there to rectify it? Then maybe another common question that they keep asking us is, yes, if I want these exemptions, is there a particular office I should go to? Do I go online? If I'm based up country, where do I go to? So those are some of the questions we generated from our audience, and we believe you are the right person to speak to them.
Basically, there are mistakes outright. And these mistakes that are made relate to the failure to follow through the conditions, whereby if someone says he's employing, say, Ugandans, they are not able to provide, say, a payroll with evidence of citizenship. Others, the mistakes they make, even after when they have gone on their list, when they have been exempted, they change the direction from the ideas that they initially got the exemption for. So at URA, we have what we call the Quality Assurance Unit. The Quality Assurance Unit has officers that make spot checks. They come at random and visit Namamve. Come and certify themselves that you're still following the conditions within which we are given the exemption. You want to apply for the exemption, you're claiming you are investing, or you've invested $100 US, but you can't prove that you have really invested. Poor documentation, no records. Yes, for us, we shall come and see a very big warehouse, but we can't tag the very big warehouse to the $100 million US. We want to see. Okay? You're applying for income tax, but you're outrightly non-compliant. the exemptions set the strategic investors. You don't file returns. The company has been in existence, say, for 3 years, and you last filed in the last year, and you only filed a provisional. So, such small mistakes. You're telling us you're investing so much in the construction. We ask you for the bill of quantities. We ask you for the approved plans in the municipalities and the cities wherever you found. Nothing is available. You don't have a certificate of Uganda Manufacturers Association and the Uganda Investment Authority. In other words, you are on a fishing expedition if you came at URA when you don't have the highlighted details. It will be like you're on a fishing expedition in the Indian Ocean, and you may not really get what you want. And the particular office, yes, the very office where I sit is called the Business Policy Division that deals with rulings and interpretations. We are the specific office that deals with the processing and administering the exemptions. At URA, we are situated on the 4th floor of the URA tower. Just in case you are up country, you can write and deposit the application, because the 10-year income tax exemption is manual. It's not yet automated like the withholding and the exemptions that are administered under Section 2BB for the non-profit organizations. Those ones are automated. So if you are up country, we request that you visit the nearest URA office and provide them with all the highlighted requirements. They will furnish them to us. Where there is need for more clarity and information, we shall reach you via your registered email and phone number on the tax profile. Then we communicate and have the ends meet. Thank you.
Thank you very much, Twaha. So for any taxpayer who wants to apply, at least Twaha has been kind enough to break it down. Our time is getting fast spent, but I just want to pick from the rich experience and vast experience of my colleagues over here. So colleagues, this goes to all of you. You advise, for Sophia and Bruno, you advise taxpayers on a daily. What's that one tip, what's that one advice you can post to a taxpayer as we wrap it up from your vast experience? In case anyone wants to know a thing or two about tax incentives from your rich experience, what can you tell that taxpayer out those ends?
I think what I would say is taxpayers need to understand the taxation landscape, be proactive with compliance, because non-compliance can end up being costly and can, in fact, ruin business. And lastly, leverage the available tax incentives.
Thank you very much, Bruno. Bruno speaks to the heart of compliance. Sophia, you advise these guys on a daily from your rich experience. What's that one tip you can give the taxpayer out there?
Thanks, Edwin. Mine doesn't differ greatly from Bruno's advice. It's really, at the end of the day, the investors must understand the legal, regulatory, and tax framework. It's important to partner with the right advisors, legal, tax, auditors, of which we have a good representation within the community. We have law firms, lawyers, we have auditing firms, and there's a number of there's a wealth of professionals that they can rely on. Missteps are very expensive, but also I think specifically for that investor coming in and looking at, we've talked a lot about the strategic investments and the strategic sectors. I think for that investor coming in and feeling that they don't fall within the strategic sectors that have been identified. In 2019, the tax laws were also amended to include, I think in the Tax Procedure Code Act, Section 44, that says the Minister of Finance is required to pay tax which the government of Uganda commits to pay on behalf of another person. So that leaves a window of discretion. So if there's an investor out there that intends to invest significant capital, beyond maybe the 10 million, and you can show that you are going to increase employment, you are going to source locally, use raw materials, the project is going to have a significant impact in a specific area or in a specific geographical location. There's still a window. And I think we have seen some of those already, the investors who have already benefited from that kind of, from that kind of discretion. As to the effectiveness, I think that's a different one. There's a lot of, criticism, but it's just to let investors know that if you don't meet the specific standard in Section 21, as my colleagues have gone in sufficient detail to explain, there's still a certain small, narrow window, unpopular window, but it's there. And if your project is big enough, you can partner with the right advisors to see how you can fit yourself within that one. Yeah, so that's my 2 cents.
Thank you very much, Sophia. And lastly, Twaha, URA is always on the receiving end. From your rich experience, what's that 1, 2?
My brother, I feel I have done injustice to the viewers out there if I will step out without talking about the most recent famous introduction of the exemption to small taxpayers. It had skipped my mind. We have that exemption where Ugandans are going to be benefiting from businesses that they are starting up effective 1st July 2025, registered in Uganda. And as long as the capital does not exceed 500 million, and we are able to, of course, compliance, file proper and accurate returns, and none of their associates has benefited from a similar tax exemption. It's on board. It came in force effective 1st July. So really, it would be an injustice if I left this panel without discussing that. That said, of course, we are aiming at formalization and promoting. Normally when you go to MBA, there is normally this question when you're doing MBA that Ugandans are considered to be the most entrepreneurial humans in the whole world, but the businesses they establish don't live to celebrate their first birthday. This comes to sort of partially this problem, because I think we have been coming in too quickly when the child has not even had milk teeth in this regard. So that said, I wrap up by saying that compliance at URA, whatever we work on is compliance. But I want also to advise the taxpayers that there are many firms out there. They should deal with reputable firms that will aid them to be compliant. Let them focus more on tax avoidance. Of course, like a taxman, I wouldn't advise someone to do tax planning, but yes, I can speak it out because it is legal. Let them have good tax practitioners to do good tax planning, other than being caught on the wrong side by doing tax evasion, because it has drastic measures. Remember, all the penalties are not even allowable deductions. When we are deriving chargeable income, we add back. So you go tax evasion, trouble lands. Tax avoidance through tax planning, they will thrive. I submit.
Thank you very much, Twaha. Ladies and gentlemen, the debate over here is coming to an end, but we can't conclude this discussion. The debate will still carry on. This was part 1 of the series on tax incentives or exemptions. We couldn't unpack everything, but on part 2 and the following parts, we shall definitely break it down further. But firstly, I would like to express our immense gratitude to our colleagues over here who made the time off their busy schedules to come speak to you, our dear taxpayers. And firstly, I would like to thank Bruno Kalibala. Bruno is a tax and legal manager at Grant Thornton. So to Bruno and the Grant Thornton team, were immensely gratified. And yeah, we're very, very thankful for the rich insights and the very informative submissions you've made over here. We believe our taxpayers have learned a thing or two. So thank you to Bruno and the GT team.
Thank you so much, Edwin, and for the opportunity to contribute to the discussion.
All right. Thanks, Bruno. The other is the only lady on the panel, Sophia Nampija. Sophia is the tax co-head at Katende Sempevo and Company Advocates. Sophia, your submissions and your advice and insights on the podcast have been very pertinent, very informative, and we believe you've impacted the vast citizenry over there. So to Sophia and the CATS team, we're equally immensely grateful to you, and we look forward to hosting you on other episodes. So thank you very much, Sophia.
Thank you, Edwin.
And lastly, to my colleague, Twaha. Twaha, it's always very good to interact and have that cordial conversation with the taxman. And that's exactly what you've done over here. You've given us insights, focus areas, and some of the key considerations you as URA, you look at when you're reviewing these incentives and exemptions and the like. So thank you very much. Twaha Kayondo is a supervisor in the Business Policy and Rulings Division of the Uganda Revenue Authority, the one that handles all these applications. So Twaha, we're immensely grateful to you as well, and to our colleagues at the tower. Thank you very much, Twaha.
I'm glad for this partnership. I'll always be available for sharing one or two, because our dear taxpayers really need this.
Thank you very much. And at the Tax Hub, we shall continue to emphasize tax compliance. That's something we do ride on very much. So, our viewers, the episode will be uploaded on our YouTube channel. Please feel free to go over there, watch not only this, but all other informative episodes we've since had on different tax topics. Like, share, and subscribe to our YouTube channel. That's where all these informative sessions will be uploaded. Thank you very much, and look forward to having you on our next episode.